It's a panic alert. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the situation has gone critical as a major country declares a banking emergency. And what I want to understand is this is the beginning of a global banking crisis that's soon going to spread to every major industrial banking center across the world. But before we get to that, a cautious tone has come across U.S. equity markets as investors are now wondering what other risks lie underneath the market that they can't see. And we're going to make the case of what they're looking at that could send stocks higher this week. But we're also going to answer one very important question. Are we at the beginning of a bear market? Now let's head over to Bloomberg, where we picked today's story up with the headline: as stocks rise as bets grow that the CBI won't derail Fed cuts. And this is a critical week once again for the equity markets. The dip buyers have come in and aggressively driven stocks up, and the data suggests that this is the proper move if you're a trader. But there's a huge risk. We get the CBI report this week, and if that comes in hotter than expected, well, it could put the Fed on ice for September. But there's a second risk. On Thursday, we get the jobs data, and of course, all of this is leaving investors wondering if the Japanese carry trade issue is over or if there's another one about to blow up. And investors will be looking for the numbers to land in a sweet spot, cool enough that no one will be second guessing the likelihood of a September rate cut, but warn investors enough to push aside recession concerns that have rattled the markets recently. And this is important because what we're seeing here is that investors really believe in the power of rate cuts. They actually understand that actually increases in the funds rate come with long and variable lags, but for some reason there's an instantaneous effect when the Fed cuts rates. We know that's not the case, but it is something that can propel markets higher as people believe in the magical powers. But is inflation likely to cool? Well, the data suggests yes. If we take a look at U.S. regular all formations gas price in red against the consumer price index in blue, and you see they're both here on a year-over-year rate of change, and they have a very strong relationship. And as we see the year-over-year rate of change for gasoline prices decline, what it suggests is that even though we might see the year-over-year rate of change actually go down, it may not go down as much as everyone hopes, but the trend here should be lower, and that can absolutely be a catalyst because that will give investors some confidence that the Fed will then have that rate cut in September. Of course, we'll get another CPI report before that and a non-farm payroll report before the next Fed meeting, but let's continue on because reduced equity positioning and a resumption of corporate share buybacks after a blackout period present a short-term window to buy the dip in U.S. stocks. This according to Scott Rubner at Goldman Sachs. And if you watched our Sunday show, you know we put a trade on for our subscribers and we limited it. We told them on the S&P 500, we believe there's some limited upside here, but that could be the sign that we're in the early stages of a bear market. But if you're concerned about chasing the risk of stocks, maybe you should look elsewhere because some of the trades we just put on for our subscribers are shooting up. One of them now up over 5% in a matter of days, and we've got some on there that are now in positions that are 10-year lows looking to go higher. Now, how do we do this? How do we help our subscribers make money and how you can do it too? Well, one thing is we look at the machine positioning every day across a broad range of equity, bond, commodity, and currency markets, and when they get in deep short positions and price moves against them, it triggers our report and flags buy signals. But maybe you like to trade momentum. Maybe you like the momentum signals like RSI, the MACD, and those other type of signals, but you find yourself getting in late and out early and bouncing around. But we look at momentum across longer periods, the 1 month, the quarterly, and the semi-annual, and we aggregate those signals together, run a proprietary overlay. The momentum shifts that flags our reports. But here's the best part. You can actually duplicate each and every trade we do, and I know that's not something you can find on other subscriptions. We give you the daily reports. We give you every signal they generate. I go through all the trades and tell you which ones I think are the best ones. We give you stop loss levels. We track the trades and the returns, both the good and the bad. We update the stop loss levels once a week. And here's the best part. You can get a 30-day free trial. So instead of chasing the equity market higher, why not look at something that's sitting near a decade low? That's where the opportunity is. Because when we look at stocks, can a cooling off of the CPI actually matter here? And the answer is yes, it can. We can go back to the .com one bubble. You see here in blue the CPI now overlaid against the NASDAQ 100. And we see the CPI cooled off a little bit, and that sent a stock rally in play. But you'll notice it did not get back to the former all-time highs. But look what happened again during the global financial crisis. We see the same thing. The CPI cooled off before shooting higher, and that kicked off a rally in stocks. But once again, it did not make new all-time highs. And that's the big question here, because if we are indeed in the early stages of a bear market, then what we'll see with this rally here is it won't get back to the all-time highs, suggesting should be looking elsewhere other than the U.S. equity market. Again, links in the description below for those 30-day free trials. I'm turning tactically bullish on equities on August 30th, Rubner said in a note to his clients today. This will be my last bearish equity markets call for August, as we're ending the worst of the equity supply and demand mismatch for August. But keep in mind that corporate share buyback blackout comes back next month. So again, this is a short-term window, which is exactly what we noted to our subscribers. A double whammy of economic uncertainty in a weak period for corporate earnings forecast is likely to cap stock market gains, as according to Morgan Stanley's Michael Wilson. The strategist among the most notable bearish voices on the U.S. equities last year said he expects the S&P 500 to trade in a range of 5,000 to 5,400 as macroeconomic data flash no clear signals over the short term, which is exactly why we noted to our subscribers we believe this is a short-term play. We talked about it on the Sunday show, and we said to our subscribers, look elsewhere. We think there's huge opportunities as markets rotate and investors look for other opportunities, and you can get into those places first. But let's talk about what's going on now in Japan as carry trade blow-up haunts the markets, rattled by rapid unwind. And keep in mind that investors really believe in the safety of U.S. equities. And this wasn't just a U.S. phenomenon. This was global investors. And we've been seeing money pour into the U.S., into money market funds, into treasuries, but in particularly the mega cap stocks, because everybody believed they were infallible until the yen carry trade blew up. And now it's starting to cause some caution among investors, wondering what else they didn't see. The yen carry trade, as it's known, was a surefire recipe for easy profits. Just borrow in Japan, the world's last haven of rock bottom interest rates, then plow them into Mexican bonds yielding over 10%, or Nvidia's soaring shares. Or how about Bitcoin? And when the yen kept falling, the loans became even cheaper to repay, and the payoffs turned that much bigger. And that was the issue here, because they took leverage plays on the U.S. equity markets, on things like cryptocurrency and bonds, and that created the bubble that we see. And the fact that the carry trade here has largely been exhausted, although there's still some risk in it, is why we're not seeing this massive overnight continuation of the U.S. equity market rally. And a further carry trade unwinding seems likely, but the most significant and destructive part of this bubble burst is now behind us. That is something that many people are hoping. The real question is, was this the only risk in U.S. stocks, or was this just the beginning of what could be a vast amount of leverage that will come unwound during the next bear market? But let's turn to China now, where we find out their banking system is once again in crisis as Beijing declares an all-out emergency, because foreign investors are now pulling a record amount of money out from China, and this is dangerous as overseas firms pulled $15 billion in the second quarter, and that is actually horrible for China because they need money to flow into the country in the most desperate way. Their banking system, their entire economy is geared around exports and the flow of foreign money into their economy. This is dangerous because we already know that the banks are insolvent, and on the back of an insolvent real estate system backed by large companies that just do not have enough money to continue the Ponzi scheme that they started in the real estate sector by building homes that people, well, they just don't have the demand for or the money to buy, now leaving, of course, China's banking system in crisis. But what's happening there is soon going to spread all across the entire global banking system. And should the decline continue for the rest of the year, it would be the first annual net outflow since at least 1990, when comparable data begins, indicating that China's economy is absolutely heading into a recession as investors are losing complete confidence in their system. The data also showed that the anomaly in the measurement of China's trade surplus continues to grow, hitting a record of 87 billion in the second quarter and taking it to almost 150 billion for the first half of the year. And what this is telling us is that internal demand. So this isn't about the anomaly in the data. What this is really about is internal demand from China is weakening because they should be importing more, and this is causing their trade surplus to widen. So what we're seeing internally in China, demand going down. You want to talk about why money is leaving the country, is because investors and hedge funds and money managers are looking there and saying, wait a minute, it's not just external demand that's causing problems in China, it's internal demand as well. You're seeing money flow out, which is going to set up another move lower in their equity markets. But now, of course, as you're about to see, this is causing problems in Chinese banking system as Beijing puts the clamps down. And now we're seeing the Chinese bonds are extending losses as the PBOC warns about potential risks. And as we see interest rates climb there, keep in mind, this is exactly what Beijing wanted, exactly what the PBOC wanted. They wanted to see interest rates go up, but now there's a huge problem. They've got to declare emergency as the PBOC hopes to limit risk from what they deem to be excessive capital flows into the bond market. And you think about why this is happening. It's everything to do with the economic malaise that they're experiencing in China. Money's flowing out of the country. The domestic demand is weakening, and now all of a sudden the banks are in trouble. They know it. They're looking to the safety of government bonds, and China's saying, no, you can't do that. It's the threat of intervention that is likely the main factor driving yields higher today, but whether or not this will last will likely depend on the actual strength of intervention. And let's take a look, because whether bond yields bottom depends on how serious the government is in fighting the deflationary impulses in China to engineer the more demand side support. And this is something that Beijing's not doing. And that's the issue here. They're doing all kinds of other things that are having absolutely no effect. And the reality of the situation is that interest rates in China continue to go down. And at the moment, yes, they're rising in the short term as Beijing puts the pressure on the banks, as you'll soon see, but it's not going to last because the economic fundamentals in China are getting worse. And so far since the third plenum, we have seen rate cuts and seen some demand side support. More is needed, not just more, a whole lot more, because now China regulators tell some rural banks to renege on bond trades. Can you imagine that, going back and telling clients, you know, we sold you some bonds, but the government says not a chance, as the government now enters a probe into bond trading as they're trying to curb the decline in interest rates there. Because you think about why money's leaving. Is it because, of course, the economy there is going into recession? Yes, that's a good reason why. Is it because internal demand is weakening? Yes, that's another one. It's also because interest rates in the U.S. and other parts of the world are higher than China, and money is chasing that opportunity. Beijing is trying to stop the outflows, because if they can't, it means their economy is headed into a recession. And that is the most generous case, because we know it takes the banks down, and they're trying to cover themselves by buying bonds. And yields in China have been hitting new lows for months amid economic pessimism and bets on interest rate cuts, prompting the government to resort to a slew of administrative steps to guide markets. And that, of course, means guide interest rates higher. But China's rural lenders have been among the most aggressive buyers of government bonds this year. And it's a very simple reason why banks buy bonds is because in an ideal situation, they would love to back deposits with loans because they pay more interest than a typical government bond. But one of the challenges, as I'll show you in the next couple of charts, is when economy's slow, banks start to worry about one important thing when they lend money, and that's getting it back. And when that becomes a foremost concern, and they believe that if they lend money out to more people that won't come back, they turn to the safety of government bonds, which is what's driving yields down. And as you're about to see, this is something that's going to happen in every major industrial banking system around the world. As we turn to the U.S. data, we'll look at commercial and industrial loans. This is shown on a year-over-year rate of change using the most weekly data available. And what we see, the market yield on 2-year treasuries. And what we note is that decelerations in commercial industrial lending lead to a decline in interest rates, because it makes perfect sense from a supply and demand perspective. If the demand for loans is going down in a debt-based economy, how do you get people to borrow? Do you raise rates? No, you lower rates. And how do banks lower rates? Because they don't have a switch or a knob that they can turn and say, we're going to bring rates down. What they do is they go out and buy bonds and back their deposits with it, and that sends rates lower until it spurs lending demand. And we could see that effect here in the mid-1980s. We see it in the late 80s going into the early 90s as lending demand contracts, dropping underneath that horizontal black line, and yields come down. You see it again in the dot-com bubble, the global financial crisis leading into the pandemic. And now you see here in the U.S., commercial industrial lending is sitting right on roughly no change on an annualized basis. Yields are starting to come down as banks buy bonds because they have no other choice but to do this. And of course, the other danger here is when you see lending go into contraction, it means money on net gets destroyed. In debt-based economy, that's one of the worst things that can happen, because that usually leads right into a recession. But there's some other data supporting the fact, well, why banks are turning to the safety of government bonds in China and around the world. As you can see here on the delinquency rate of consumer loans at all U.S. commercial banks. Again, banks get concerned when they can't get their money back, or they perceive they're not going to get their money back. They turn to the safety of government bonds. And as you see the delinquency rate rising in blue, what happens? 2-year yields are falling. And this relationship happens each and every time, except here in the short term, what we saw is hedge funds and investors all around the world believe that the U.S. must drive rates higher on the back that the Fed drove rates up. And what we're going to see is a big collapse in yields as delinquencies head higher and banks are indeed forced to buy bonds. And so we see now China declaring emergency, threatening the world banks to disclose who is buying these bonds and actually to renege on those to get rates higher. What they don't realize, they're about to plunge not only their entire economy into a deep, protracted recession. This is going to happen all around the world, because when interest rates go down, it indicates financial conditions are tightening, and at some point they continue to tighten until they break. That's when all the leverage in the equity markets around the world comes out, and there's a good reason U.S. investors are panicking, because of what happened in Japan with the yen carry trade. It's only the beginning of what will be a massive unwind of leverage in the U.S. equity markets. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.